Without further delay, I'd like to introduce Nicola Wealth Chairman and CEO, John Nicola, a veteran of the financial services industry. John provides strategic leadership through his passion for innovative solutions to clients. For you, John.
Thanks very much, Ethan, and good morning, everybody. They say, may we live in interesting times. I'm hoping over the next 45 minutes, we get to have a chance to take a look at what's occurring in our world and maybe where this might be taking us, if not for the rest of the year, over the next few years. So let me start really with a sort of an agenda of where we're going to go with this. I just want to be sure that, here we go. So we're going to take a look at where markets are today. We will compare private versus public assets. We're going to take some time on the tax efficiency of portfolios and, in fact, the issues related to what might occur with taxation as we move forward. And finally, and I was doing a presentation to an investment group a few weeks ago, and it seemed that one of the biggest questions that they wanted to address is, with all the unbelievable amount of debt that's being triggered around the world by governments, there's no country where huge amounts of debt are not being issued now to sort of combat the economic impact of this crisis. Well, how will that debt get repaid, and what will the impact on inflation be as a result of trying to deal with the staggering amount of debt? So we're going to take a look at that as well. I think one of the challenges I find, and when I look at what's going on in the media, is that there is a great deal of tendency to extrapolate. In other words, we tend to look, and if we define extrapolation as to extend the application of a method or conclusion, especially one based on statistics, to an unknown situation by assuming that existing trends will continue or similar methods will be applicable. And we have a tendency to extrapolate, and this crisis is no different. So for example, I noticed that when people talk about post-COVID, they talk about an environment, for instance, that includes social distancing, that includes the way we would work more remotely from home, any number of things in terms of how we would entertain ourselves, or certain sports may be eliminated entirely. Will we ever go back to a movie? And so it goes on. And the interesting thing is that that is an extrapolation of where we are today. And it certainly isn't post-COVID, because post-COVID means no COVID. It means essentially that what they're talking about is how will we behave in an environment where coronavirus is still a threat. But post-COVID means that at that point in time, we've got to some level where that no longer is a threat. And that's a different kind of environment to look at. The other things that are going on, especially on extrapolation, is that there's been a connection here between people writing all kinds of articles about how this pandemic is going to create or is creating a depression as large as the Great Depression from 1929 all the way through, essentially all the way through to the beginning of World War II. Now, let's take a look at that time in history and just see if the comparison is valid. For starters, in 1929, the economy dropped from 29 all the way through to the beginning of 1933. The drop in economic activity was 25%, and it took 7 years to recover. From an unemployment perspective, unemployment rate almost peaked at 25% in the US and did take 13 years to recover. Basically, it only recovered as a result of World War II making a huge difference in terms of manufacturing. Now today, just last month, the US unemployment rate actually started to drop. I think 2.9 million jobs were created. And in Canada, something like 290,000 new jobs were created last month. So there is potentially an argument that we may have got to a point where we are at the highest level of unemployment during this crisis, which would be a fraction of what it was during the Great Depression. And the other factors of the Great Depression include the fact that at that time, there was no unemployment insurance. There was no Social Security or Canada pension plan, and there was no deposit insurance. Hundreds of thousands of people lost their entire savings as banks went out of business. So I think it's unreasonable to even remotely compare what we're looking at today with the Great Depression. One of the phrases in equity markets is that stocks climb a wall of worry. And what do we mean by a wall of worry? Well, it could be a trade war, or obviously in this case, we're in the middle of a massive recession. It could be global bond yields, in the past Brexit, Hong Kong protests, the 2020 election, and of course, obviously the big elephant in the room right now is, of course, the coronavirus. And the stock market certainly seems to be doing a pretty good job of climbing that wall of worry, because if we take a look at what's happened so far this year, um, once the lockdown really started to clamp down, especially in North America, markets peaked and then dropped very dramatically over a number of weeks by 35%, peaking in March 23rd. But since that time, they've managed a 44% recovery, and that has been enough, climbing that wall of worry, to put it within 1% of where it started 2020. So the question is, all right, well, is that it? Are we done here? Are we finished? And I would argue that this is more likely to be a dead cat bounce than actually an actual recovery. We're going to take a look at the numbers, but the other thing to note is that while this is true for the S&P 500, the rest of the world doesn't seem to be enjoying this quite as much. When we take a look at the actual returns across global markets, and that includes the New York Stock Exchange, which is a broader index of American companies than the S&P 500 is, on balance, they're down still 12% on a year-to-date basis. So let's take a look here. This is from The Economist magazine, came out a couple of weeks ago, and it's talking about the impact on various industries in the US in particular, and which ones are going to be impacted the most. And as you can see, in some areas, the impact of the drop in earnings that's expected for utilities, technology, healthcare is minimal. In some cases, growth is expected. But when you look at financials, industrials, consumer discretionary, and energy, the impact is enormous. And overall, the drop expected is 20%. Now we're going to take a look at the stock market and how expensive it is in relative terms. And when I'm talking about the stock market, I'm referring to, in this case, the S&P 500. But the S&P 500 was expensive at the end of last year. And this year, it's almost certain that the companies in that index will be making 20% less than they made at the end of last year, at the end of 2020. So if we thought the market was expensive at the end of last year, it's going to be 25% more expensive this year if it stays even for the year. So one question you want to maybe ask yourself when it comes times to deciding on what you're going to do with public investing is this. How would you invest and allocate your capital if it was committed for 5 years? If you were investing in real estate or private equity, you would ask this question, knowing your capital was committed for 5 years. And I'm going to make a suggestion that it makes sense when you're making an investment in public markets to consider a 5-year approach, not what's going to happen in 3 months or even in 12 months. We're going to take a look here because we have obviously we've just gone through a bear market, and we may go through another one, and it may even occur this year. So I wrote an article, I guess maybe 6 weeks ago, The Anatomy of Bear Markets, and we took a look at all of the bear markets that have occurred since 1929. And if I'm not mistaken, I believe there were 26 or 27 of them where the market has dropped by 20% or more, and then it's measured in the length of days. On average, bear markets lose 35%, which is exactly what happened earlier this year, and they last for 300 days, not 6 weeks. So let's take a look at the grandfather of them all, which is the Great Depression. In actual fact, the markets peaked, as we know, in 1929. It took until 1954, which essentially is 1 depression and 4 recessions and a world war, before the stock market got back to where it was in 1929. If we take a look at more recent periods of time, we would see that post or towards the end of the Vietnam War, there was an oil embargo as well going on in 1973, 74. So essentially the economy was going through a very rapid rise in inflation, and stock markets stumbled in this pace from 1972 to 1980. The stock market dropped 45%. It took 15 months before that occurred. A major recession, actually one occurred completely there, and one began in 1979, early 1980. And the market took about 7.5 years to recover to its prior peak. But the problem with this analysis is it doesn't take into account the impact of inflation. So when you invest in equities and stocks, especially public companies, you expect that they will be inflation, they will protect you in terms of your buying power, your purchasing power. If we adjust this graph and reflect the impact of inflation, in actual fact, the market peaked in 1968 at 791.86 and didn't get back to that level for 24 years, till January 1993. In other words, almost as long as the Great Depression. And there were 5 recessions in this period of time before you got back to that period of time. So this is, again, not unusual. And finally, if we take a look at how this century's worked out for us, we started the century with the dot-com bubble and then a very significant drop in the market, about 49% drop. And it didn't get to the bottom until 1 year after the recession was over. And then in the Great Recession, the Great Financial Recession of 2007, 8, and 9, the market dropped 57%, but it bottomed before the recession was over. So there was no pattern here. And overall, it was like riding a wave. Essentially, you were nowhere in terms of the actual return of equities, except for dividends, for 12.5 years. And that's part of the reason why we know that the volatility in equity markets has, first off, it's existed for decades, ever since markets existed, public markets in particular. And so when we take a look at a portfolio design, we take a far different view. If you went to our website, what you would find is this chart, and it shows the returns that our clients have earned across the board in our core portfolio, core performance, since 2000, the January 2000. And it's 6.75% is their weighted rate of return net of fees. This is what's called the Talmud asset allocation model. And it's been used by a number of advisors, in particular in the Eastern United States. And it's really sort of has some Old Testament biblical explanations. If you look at it, the assumption is that you would have 1/3 of your assets in real estate, in this case, the land that you farmed. You would have 1/3 of your assets in business, and that would be your goats and your sheep or your cattle or your corn or whatever you did as a farmer. And 1/3 of your assets would be in reserves. Back then, it would have been gold and silver. And today, that would be the equivalent of fixed income. So really what happens is they apply this to the modern world. And that would mean 1/3 in equities, 1/3 in real estate, and 1/3 in fixed income. And the equities could be public or private. And they would just rebalance this every year, and they've actually achieved some pretty impressive results. In fact, when we take a look at our returns compared to the TSX Composite, which is 100% equities, the S&P 500, the Morgan Stanley World Index, and the Morningstar Neutral Balance. This is an average of Canadian funds for the last 20 years. In all cases, there's a significant difference. In fact, a person with $1 million in 2000 would now have 1.43 million more in a portfolio such as our core performance than they would if they'd been in a 60-40 balanced portfolio over the last 20 years. And on a year-to-date basis, the difference is that our clients in core are down approximately 1% year-to-date, as opposed to about just over 3.5% for a 60-40 portfolio. So we're very comfortable that this is a better asset allocation model, and let's move on to see exactly how that might work in the public versus private discussion. And sometimes the problem with this debate is that it's a debate about what's better. Should I invest in public assets or private assets? And it's really not that kind of debate. Jim Collins wrote a great book called Built to Last, and in it he talked about the tyranny of the or, as in public or private, as opposed to the genius of the and, public and private. And that's really what we want to take a look at today. So when we take a look at returns, we would see, this is from a private equity review of performance from December 2000 to June 2019. The S&P total return was 6.7%. The Russell 3000, which is a smaller cap environment, is slightly higher, and it should be higher because in theory it would be a higher risk equity portfolio. And finally, the private equity at 9.1%, which is also smaller cap. Private equity typically the companies are smaller than they would be in publicly traded markets. Is about $5.4 million, or about 2.4% a year higher than the S&P 500 for the last roughly 20 years. Now, part of the issue to look at here is that there's obviously been a growth in private assets, and not just in private equity. And there has to be some reasonable explanation as to why this is. And part of that explanation is that in the US, and this is 100% true in Canada as well, the number of publicly traded companies that you can actually invest in has declined by 56%. Something like 4,000 companies that used to be listed in the US 20 years ago no longer are listed. So they've either gone out of business, they've been absorbed and consolidated by other companies. In addition to that, companies have been for many, many years buying back their own shares. And part of the reason for that is they would like to use that to help increase the value of their shares. And I no doubt a large part of that's got to do with the way that compensation works for executives tied to stock options and restricted share units. Regardless of the reason, the amount that's been redeemed on a consistent basis is huge. In fact, you can see the correlation here. The black line here represents the S&P 500. The green bars represent the rate of share buybacks in the S&P 500, and it's incredibly aligned with the performance of the markets. This is through to the middle of 2019. So $700 billion in share buybacks occurred in 2019. So where is this money going? Because it's not going back in the markets. So we've got this trailing redemption of shares, and we now on the right-hand side can take a look at how much money has been going into global private capital, assets under management. As you can see, it's now approaching $7 trillion towards the end of last year, June of last year, actually. And it's interesting that amount has increased by $4.5 trillion since 2009, since the last recession. At the same time, share buybacks in the same period of time have been $5 trillion. So a large part of the money that's gone into private capital, private equity, has actually come as a result of being extracted from public markets. But in this case, not extracted because people were selling shares in public companies, but because their shares were canceled or redeemed, and the money did not go back in those markets. If we take a look at, this is towards the end of last year as well. Now we're looking at the world exchange market capitalization. So this is the value of all publicly traded markets in the world. And last year it ended just over $85 trillion, US trillion dollars, for all equity markets in the world. Keeping in mind that we just mentioned that the value of global private capital at the end of last year was a little under $7 trillion, only 7.5% of public markets. But it can be argued that if you actually were able to value all private companies around the world, they would equal, roughly speaking, the value of all public markets around the world, because obviously the firms are smaller, but there's a multiple in terms of the number of private companies versus public companies on a global basis. So, and June 2020, we would see obviously those public markets would have dropped, but they would still be over $75 trillion, comfortably 10 times the size of the investable private equity marketplace. Now, the other thing that's been a criticism of private markets is that people are now paying quite a bit more. Companies are paying a lot more for private companies today than they were, let's say, 10 years ago. And that's completely correct, roughly 40% higher. So back in 2009, companies might have been bought for 8 times what's called EBITDA or pre-tax cash flow. And today that might be 11 or 12 times that same number. So 40% more expensive to buy those companies. But that comparison doesn't really mean anything unless we look at how public markets are. So in 2009, the same year we're looking at for private equity, the PE ratio on a 10-year trailing basis, what's called the Cape-Shiller Index, was 14 for the S&P 500 when at the nadir of the marketplace. And at the end of last year, it hit 32. That's an increase of 130% more since 2009, a far, far faster rise in the price you're paying for $1 of income than you would experience in private equity. So much more expensive. And now, because we're expecting earnings in the S&P 500 to be 20% lower, but the S&P 500 is almost exactly where it was at the end of last year, we're now looking at a trailing PE ratio that could be pushing 40. So much, much higher than you would experience in private equity. The other thing to take a look at is where are large institutions, sophisticated investors putting their money. Here's an example. Yale Endowment is over 60%. The Canada Pension Plan Investment Board is currently at 41% of their assets in private equity or private debts combined. And if we take a look at institutions generally, 65% of them have an allocation to private equity. And if we take a look at Tiger 21, if you're not familiar with Tiger 21, this is a group of investors. They're expected to have at least 10 million of investable assets, and they get together in a kind of a club format and discuss portfolios and take a look at where they're investing. And then this information from Tiger 21 is actually collected. And the last time I took a look at it, this was towards the end of last year, the allocation towards private equity and real estate combined was in excess of 50%. So there are issues in trying to deal with the risk element of private assets. And so we are looking to identify, mitigate, and avoid that. And 4 areas to consider are diversification, how to manage costs, taking a look at what we would call an evergreen structure that's tied into what is known as a waterfall approach to investing. So let's take a look at a couple of these to see how we can reduce risk and enjoy the returns of private equity without maybe quite the challenges that some of it presents, I should say. So let's start with the private equity firms themselves. Typically, when you are investing in private equity, the requirement is that you have to pay fees, 2% on committed capital for 5 years. If you don't understand what 2% of committed capital means, it means then that you've gone to this private equity firm and said, okay, you can invest with us in our partnership. We will, you're going to give us $1 million to invest, but right now we only need 100,000 in the first year, and we're going to invest your $1 million along with everybody else's money over a 5-year period of time. The issue is you pay 2% fee on your $1 million for the first 5 years, regardless of how much you've got invested. So if 80% of the funds were committed, if 80% of the committed funds were invested over 5 years, then your average fee for the first 5 years is 5% a year, and then you'll pay a performance fee on top of that. Let's compare that to a different model where, for instance, with one of our partner groups, Northern Private Capital, we invest with them, and our fee with them is 1.5%, not 2%, and it's only on invested capital. We offer, if we get to do co-invest with them, which we have done, our fees are reduced further so that our blended fee is under 1% a year. And that means then that since performance fees are also lower, our expected costs with them are going to be about 75% lower over the first 5 years. In other words, almost 4% a year lower, which is obviously a much better way to get a net rate of return through to our clients. So fees make a difference. Diversification includes managers, vintages, geography, the industries we invest in, and the asset classes. You don't just need to look at private equity. There's private debt, there's infrastructure, there's real estate. These are all private assets. So if we take a look at our private equity fund as it's structured now, it's currently about $275 million, made up of 21 funds, 12 managers, 14 direct co-invest investments. We like direct and co-invest investments because A, we get to help underwrite whether we want to make that investment, and B, the fees are lower, so we get generally a better longer-term return. We want to look at global companies as well, and when we take a look at the results, our private equity funds for the last 5 years has actually earned, as of the end of March, a 4% higher rate of return per year than the average of all of our publicly traded equity funds combined. Let's take a look at the impact of closed-end versus evergreen. Most private equity funds that you can invest in are in fact closed-end. Once you make a commitment, you are there for an extended period of time. So first out, usually the minimum investment is significant. When I mentioned $1 million, that it tends to be at the low end of what individual limited partners are expected to put up in most private equity pools. The 5-year funding period exists, but the overall fund is typically 10 to 14 years long. Liquidity only occurs when assets are sold. The investor is responsible for dry powder. That means that if you have committed $1 million, but you've only put in $100,000, you don't know when the other $900,000 is going to be drawn down. So you have to keep it in something relatively liquid, and you are likely to earn a significantly lower rate of return on that dry powder, and that needs to be factored into your total rate of return. Now, in an evergreen fund, the minimums are far smaller. I mean, in our case, the minimums are effectively $25,000. There's no other capital commitments beyond anything that one initially invests. The minimum hold period is between 1 and 3 years typically on evergreen funds. Liquidity is periodic. It could be monthly, quarterly, or annually. You can add new capital when you choose to add new capital, as you would with most other investments. The other thing to look at is that private equity isn't the only option. In the US, for example, while the private equity market is quite large at $3.4 trillion alone, the private debt market is not exactly small at $770 billion. It's significant. And the advantages of private debt is it has lower risk than private equity, lower returns, to be fair. It is a shorter duration, so you're not committed for such a long period of time. You're getting current income in the form of interest income. And depending on how it's designed, it can be RSP or TFSA or foundation eligible, which means that if it's interest income in that environment, you're not paying tax. And tax is something that we do need to factor into. So I mentioned I would cover the issue of tax. And let's take a look at where we are. People in BC, and it's not just BC, but we went through this experience just before the shutdown in February 2020. We had a new budget which increased tax rates on top income earners. And Roger Bootle has written an article now. This is subsequent to the lockdown, saying that it will not be a surprise to see wealth taxes implemented around the world. So the question is, what do we have to worry about? And more importantly, what might we do about that? Jack Mintz makes the obvious point that rising tax rates to pay new debts may not work. I think there's a fairly good argument there, and we're going to take a look at that when we take a look at the debt issue itself. But when we look at what's occurred in BC, so what I've got here at the top, you'll see these bars, which includes the 2019 tax rate, today's tax rates, the 2013 tax rates in BC, and the increase over the last 7 years. So in salary and bonus, we went from 49.8 to 53.5. We used to be at 43.7. Tax rates at the top have gone up 22.4%. But on eligible dividends, they've gone from 25.8% to 36.5. That is actually an increase of 41.5%. So dividends are taxed at an even higher rate for eligible dividends. That's the kind of dividend you would get, let's say, on your shares in the Royal Bank. And on capital gains, the tax rates are also up 22.4% from 21.9 to 26.8 over the last 7 years. And on ineligible dividends, the difference is even greater. The tax increase is almost 45%. The top tax rate on ineligible dividends, these are dividends from companies that pay the small business tax rate, are 48.8%. They used to be 33.7. That's a very significant increase. So this changes the way compensation should work, and that's another issue for our clients to consider. They need to sit down with their advisors with our firm to talk about exactly what needs to be different in 2020. This is not too late to be doing this kind of planning. And the other thing that makes a difference is that because of the tax reform changes that started in 2017 and the BC changes, it means that some of our clients are going to be going from what used to be last year a tax rate of 31.4% on dividends to 48.8%. And that absolutely changes the way that they might want to organize their portfolio and their compensation. So we mentioned this. These are the things that we're talking about. One of the things that's really interesting is to take a look at how long it takes during a recession. This is the Great Recession of 2008, and it took 5 years to recover tax revenue. So this, regardless of how well we come out of this, there's going to be a long time before you really see full recovery. And an interesting thing, there's been a large number of conversations about how much wealth has been concentrated, in the top, in this case, 0.1% of the population. This is the graph from The Economist magazine, and it shows that the top 0.1% used to have 9% of the American wealth and almost got to 15% by 2016. This is over a period, obviously, of almost 30 years. But when you include Social Security, in actual fact, they ended up with 10% of the wealth within the U.S., and they started with 8. So there was an increase, but not nearly as much. So when if we're not measuring the right things, in other words, if we're not measuring the value of let's say in your case, CPP. So CPP, for example, is, I think, roughly the assets, the last time I looked, were about $420 billion. And those assets belong to Canadians. But not one nickel of that 420 billion shows up on any Canadian's net worth statement, not a nickel. And that would be true for all defined benefit plans, which would be well in excess of $1 trillion of wealth in Canada is not showing up on any beneficiary's net worth statement. But obviously it is an important part of their net worth and their financial security. So these are the issues that we're looking at from a planning perspective. So I'm dilly-dallying here. It's because I'm having to move things around here. So we want to reduce taxable income to below $220,000. We want to take a look at income splitting. Fortunately, for those of you that have family trusts or minors, you can now income split, at least certainly as of June 30th, with lower cost loan rates that have been available for the last 2 or 3 years. They're going to be 1% starting in July. Charitable giving is always a great way actually to lower one's taxes and make do some good in the world as well. Flow through shares under certain limited circumstances can be effective. And the advanced tax planning is the issue for most of you. You need to take a look at the way, whether you're incorporated or not incorporated. If you are incorporated, are you taking a salary? Are you taking capital gains? Are you taking dividends? And all of those things are important. And then the last thing is non-traditional portfolio design, which is what I'd like to look at right now. So this is our core portfolio asset allocation. Roughly speaking, 57% of the assets we're managing for clients are in public markets, and 43% are in private markets, in private debt and real estate, private equity, etc. Let's take a look at just the private side of this. As things stand now, on private assets, mortgages and private debt, they're both private assets. As long as we keep them in areas such as RSPs, IPPs, and TFSAs, while they generate interest income that's 100% taxable, there's no tax to pay as long as they're in those environments. And then the other assets, private equity, real estate, and infrastructure, generate less tax. How much less tax? Well, let's take a look at what happened over the last 5 years. This is just taking a look at the equity part of our private asset that we manage. So imagine we started with $1 million 5 years ago. Today, that would be worth roughly $1.65 million. And of that, the gain would be $658,000. The taxable income, interestingly, is only $156,000, not even 25% of that total. And the tax paid after fees and RDTOH credits that an incorporated investor would realize, it was only $10,070. And if we look at the actual math, the gross return before fees was 10.7%, and depending on the fees one pays with us, let's assume the net return after fees is 9.7%, and the net return after taxes is almost exactly the same at 9.6%. So how is this possible? Well, RDTOH, which is a special tax credit available to Canadian controlled private corporations, can reduce corporate tax by 60%. A low turnover of assets, typically in private assets, we do not buy and sell or trade on a regular basis. Depreciation with respect to real estate makes a big difference in terms of how much of the rental income is taxable, and planning fees are deductible. When we add them all up, that's the result we get. And if we blend these two things together, in other words, we blend the fixed income side, the mortgages and the private debt, with the hard asset real estate, infrastructure, and private equity, we get a slightly different result. $1 million, our ending capital is going to be lower because we're in more conservative assets now. Fixed income is roughly about a third of the total. The gain is 579. The taxable income is 116. Interestingly, because a lot of the interest income has been sheltered, the actual tax is zero for the last 5 years. Since these are the actual results for the period 2014 through 2019. So the gross return was 9.6, the net return was 8.6, and the net return after taxes was also 8.6. Again, this is possible because of the interest income in registered plans. Private assets have the low turnover, as we mentioned, and it's a balanced portfolio. So it has a lower return and lower risk, but it also generates about 4% cash on cash income annually. So again, it's possible, even in a higher tax environment, to design a very efficient portfolio. So what are the things one can learn from this? Planning first, portfolio design and financial planning make a big difference. And this is something, even if we're remote and we can do this kind of planning with any of our clients without having to meet on a face-to-face basis. You want to diversify. You want to remember that cash flow matters. Private does not mean higher risk, and we're going to take a quick look at this in a couple of minutes, but it does mean less liquidity, and we'll explore this a bit more. How much of your returns are taxable is a key question to ask, and then obviously what can you do about that? All right, so let's take a look at the issues that are facing us today. We've got coronavirus, which is creating a global economic crisis. The markets have been down. And it raises interesting question. I just was looking up the word crisis. We all know it's supposed to be some blend of danger and opportunity. This was actually first announced to Westerners by John Kennedy in his speech he gave as a senator in 1959. But upon looking at this a bit more carefully, I found out this. Therefore, it could be somewhat misleading and biased to translate "ji" in the context of the word "weiji" to opportunity instead of a changing point or a confidential event. So let's just change the definition of crisis. Are we at a changing point? Well, certainly with respect to flying, I would say that case is pretty true. This is the expected outcomes for flights in Canada in terms of how long will they get back to the pre-2020 levels. And based on this estimate of both Tier 1 and Tier 2 airports in Canada, the expectation is 5 years to recover. And what about what's going on in oil markets? This is a geopolitical strategist I've listened to for many years. I quite like his work, and he had a really good seminar on the impact of global oil markets, including an interesting observation about what's going on. He expected, obviously there's been a massive drop in markets demand. At one point, almost 25 million barrels a day drop in demand from 100 million to 75 million barrels a day. And then he said, well, which countries are going to have a permanent impact? And interestingly, he thought the country most vulnerable to this was Canada, specifically Alberta. And he's expecting something like 70% of Alberta oil at some point in time will get shut in. Now, so far that hasn't happened, but there have been points in time where Alberta oil essentially has been selling for incredibly low prices. In fact, as you saw just a month ago, for negative prices for a brief period of time. So there are going to be some challenges in the oil marketplace. Other issues, of course, include the whole how will return to work occur, and this we discussed this in another newsletter written a few weeks ago called "Tempest in a Trumpet," and our dear Donald, of course, is never short for words about what the rest of the world should be doing. But this slide is connected to that. We're sort of waiting for a vaccine to tell us we're safe. But the reality is that actually getting a vaccine for any virus is challenging. On average, it took 10 years for each of these, on average, to get to a point where a virus was discovered. So when we take a look at the impact, we say, okay, what are the beneficiaries of remote work and where might the pain be felt? So obviously we'd have less pollution, lower carbon footprint, less traffic, which would obviously impact the oil industry. Commuting time would be saved, company overhead related to space, parking, and travel, affordable education models because they would be online. I'm sure there's a much longer list. The pain would be felt in oil, in downtown retail, and restaurants, in demand for office space, auto sales, parking garages, Uber lifts and taxis, business travel, of course, and reduction in social connectedness. So there's winners and losers in all of these situations. And it reminded me of this quote from my mind's just gone completely blank here. I'm just going to read the quote and then I'll remember who exactly said it. It's not the strongest of the species, of course it was Darwin, that survives, nor the most intelligent that survives. It is the one that is the most adaptable to change, that lives within the means available and works cooperatively against common threats. And that may perfectly describe the environment we're actually in. So one of the things our clients have asked about, because we have a large investment in real estate, both in the US and in Canada, is how is that looking? This is from the Wall Street Journal, and it's trying to impact which kinds of stores are likely to close and remain closed as a result of what is occurring in the marketplace. This is, I guess, another way of looking at the Amazon effect being accelerated by coronavirus. And as you can see, they expect 100,000 stores will have to close over 5 years. That's 100,000 stores out of 900,000 stores that exist today. I will point out, however, that the US has, roughly speaking, twice as much retail space per person as Europe does. So this might have been something that one would have expected to occur regardless of whether or not we had coronavirus. With respect to our own portfolio, here's what we can tell you. We have now taken a look at rents for April, for May, and the early part of June. And initially, we were at a 90% recovery rate in Canada on rent collection. That now has increased to 95% for April, May, and June. And in the US, we got to April rent collection initially of 93%. That is now at 98%. So it's actually been far better than expected. We're very happy with those outcomes, and we actually expect them to continue. One of the things I think that's important about real estate is sometimes people look at hard asset real estate and say, well, it's really not properly priced, because, it's not publicly traded. What you're looking at is a really messy graph, and I'm just going to focus on 2 points of it. This is actually two measures of the real estate trust in Canada and marketplace, and it's taking a look at comparing it. And if you can just see my cursor here, that line in the middle means that REITs are trading exactly at the value of the real estate. In other words, whatever the real estate could be bought or sold for. Most of the time, REITs, as you can see, trade above that line, and sometimes they trade below that line. So they traded significantly below that line in 2007, 8, and 9. And that was a time when the cheapest place to buy real estate was actually in the stock market. And the same thing occurred in the early part of this year. Not quite as dramatic, but not insignificant either. So the REIT marketplace is the public marketplace. The actual marketplace for real estate is what buildings are bought and sold for. So when we take a look at this even more complicated graph, I must apologize for that, it tries to take a look at comparing the value of REITs with how much they are yielding above Government of Canada bonds. So what we're looking for is this gray line right here refers to the REIT yield and compares it to 10-year government bonds. When REITs were incredibly expensive, this is very expensive REITs right there, and the spread was only 129 basis points. When REITs were very, very, very cheap, as they were in 2009, roughly about March 2009, the actual REIT yield was about 9 percentage points higher than the Government of Canada 10-year bond rates. And where we are today, 6.5%. So in other words, there's a fairly big gap. So REITs are yielding about 6.5% more than the government of Canada 10-year bond rate, which is currently only around 65 basis points. So what we're looking for in real estate is the following: geographic diversification. We're looking at a growing population. Residential is still the safest, and arguably industrial would be the next safest. Some retail will still work. Regional neighborhood malls will still work. Those where you can add value by looking at development opportunities. Build to own is effective. We've certainly found that to be true, especially in residential. And the big thing is the spread between cap rates and mortgage rates. In other words, it's not simply that you're taking a look at the fact that rental income might be flattening or dropping. You've got to compare that to what are you paying for mortgage rates. We've just recently refinanced a residential building in Victoria with CMHC at a rate of 1.7%, which is an unbelievably low rate that we've never seen before. So when we take a look at the returns, the Canadian income on the real estate, for the last 1, 5, and 10 years, the returns have been between 8.2 and 9.8% per year. In the US, between 11.8 and 11.2%. And in the value add, which is a higher risk development pool, the returns have been over the 1 and 5 years, 13.9 and 15.5% per year. So they've done well. We still have a lot of comfort that this is a good place to earn very good risk-adjusted rates of return going forward. Let's take a look at some of the other areas where maybe opportunity exists. And some assets have had dramatic pullbacks, and that really quite surprising. This is our preferred share pool, and you can see that this is not the first time. It had a major impact on pricing in 2015 as well. And as a result of that, year-to-date basis as of April, it's a little worse now. At the end of May, it's down about 19% year-to-date. And actually, it's had a very, very disappointing rate of return of 2% a year because of these two major market corrections over the last 11 years. Now, the reason I mention this is because, coincidentally, the Canadian equities are also down 17% in the first 4 months of the year, but up 7.5% per year for the last 11 years. So much better than preferred shares over 11 years, but not better over the first 4 months of this year. So the question would be this: would you consider reducing your risk in equities by selling Canadian equities, which are down 17%, and buying preferred shares, which are also down 17%, knowing that by doing that, you would get a 6% yield versus 3% on this publicly traded stocks? And that 6% yield in Canada is effectively the pre-tax equivalent of 9% being paid on bonds, which is an extraordinary rate today. The other thing to remember is that we believe very strongly in rebalancing. So you're looking at another busy slide, and it represents my own portfolio in preferred shares. And what I've done on a consistent basis is rebalance. Every time preferred shares have taken a major reduction, I've simply sold some other assets and added to my preferred shares, because fundamentally the risk of default on these shares is very low. So the return since inception that I've experienced, which is the same 11 years that we've had the fund available, is 11.1% a year, not the 2% that the fund has earned. So just because an asset class has a low rate of return over a period of time doesn't mean to say that you would experience that if you were disciplined and rebalancing on a regular basis. So what you're looking for is the following. The issue is our preferred shares are financially sound. Low price equals a higher yield. That's one of the pluses of buying when the prices have dropped. Excuse me. They're taxed very much at favorable rates, and you have to have a discipline of rebalancing for all asset classes, not just preferred shares. In my case, I don't intend to sell Canadian equities to buy preferred shares, but what I have done is sold high yield bonds. And the reason for that is that the high yield bonds have a similar risk profile, maybe even a higher risk profile than preferred shares. But so far this year, they're up 3.7%, and the preferred shares are down 19.8%. So remember that slogan, you want to sell high and buy low. This is a great exchange to make in this environment. Another issue which is related to the impact of oil is we have developed a sustainable innovation fund. It's focused on renewable energy, innovative transportation, clean technology, et cetera, and it's done quite well. It's an interesting thing about renewable energy is the assumption is that the lower the price of oil goes, the harder it's going to be to implement renewable energy. This graph suggests that's not actually the case. So the price of oil has been basically falling since 2007. And at the same time, the implementation of renewable energy has been consistently high. So that's driven to a large degree by the fact that the cost of energy is continually dropping, renewable energy. In fact, now, if you take a look at this graph from The Economist, you'll see that offshore wind, solar, onshore wind, and fossil fuels are converging in terms of costs. So there's no longer a cost advantage. The issues for offshore wind and solar are more related to transmission and storage, and that's why the last part of the graph, battery storage costs, becomes a large part of how quickly renewables will get implemented. So we want to increase our investments in renewable energy. Part of our theme here is that there, and when you, just before I get into that, let's just take a look at the result. This is the year-to-date results as of the end of May. For global equities, for US equities, now the reason this looks better than my earlier graphs is that this is in Canadian dollars as opposed to US dollars. The core portfolio is down 1%, and sustainable innovation is up 5.7%, so more than US equities and significantly more than global equities. The theme here is very simple. Renewable energy and innovation will grow faster than the overall economy. So you're not just investing in something like this because it's actually good governance and good policy or good for climate change, because those things are all true, but you are investing in addition because this is part of the economy that will grow faster than the economy overall. Let's last take a look at this issue of debt. Can the governments afford the debts they are piling up to stabilize economies? I'm going to make an argument that might surprise you. So we took a look, we go back into history, and we take a look at English debt, going back to the Napoleonic Wars, and we find that at one point in time, English debt to GDP was 200% of the economy. It got to 190% at World War I, 250% in World War II, and then, of course, the 2008 financial crash came along, and it went back to 80%. And if we take a look at what's considered the post-COVID result, given how much money has been printed by the Bank of England, it's expected to reach probably 100% of GDP in England, maybe in 2021, 2022. But that pales in comparison to where it's been historically. Now let's take a look at Canada. This is an interesting study that the Fraser Institute did, and I want to thank them for the work they did on this. They decided after the 150th birthday of Canada to take a look at exactly how we've been spending money on a federal basis. And what they found was the following. So this is what we want to look at. That yellow mark is how much of GDP do we have to spend servicing the interest on our debt? You know, and there are times, World War I, the Depression, World War II, where it peaked, but not nearly as much as it peaked during the Mulroney years in the 90s. And today, the debt service that we're going through is about 1% of GDP, or less than 20% of what it was in the mid-90s. It's a fraction of what it was in the mid-90s. Now let's take a look at the other parts of the graph. The assumption we have made typically, depending on which political side you're on, is that public spending is continuing to grow at outrageous levels and essentially can't be sustained. But in actual fact, when you take a look at this graph, the expenditure and the revenue, the impact on the overall GDP, not much really has changed since the Second World War is over. It's almost a completely flat line. And then the question about, well, how are we going to pay off the debt? This is going back to 1867. If you're looking at this, you see this line here, this 0% line here is really simple. If we're in surplus, we're above the line. If we're in deficit, we're below the line. Clearly, we're in deficit most of the time, which means we don't actually pay off the debt. So when we take a look at our net debt to GDP, again, we see that this might rise by 20%. This is the number for the end of 2017. This might rise by 20% at the end of 2021, 2022, but the fact is it will still be lower than many other prior peaks, including World War II and what I mentioned before, where it peaked in the 90s as well. And finally, this one is related to public debt charges. In other words, how much of federal spending is used to service public debt charges? So again, after World War I, 40% of the budget was needed to pay interest on the debt. It was 20% of the budget in the end of World War II. It was 30% of the budget during the 90s when we got really out of control with our debt. And as of the end of 2017, and roughly the same last year, it's around 7% of the debt. So quite frankly, the amount of debt we're about to take on is affordable, not just because interest rates have lowered, but because it's not that high and it wasn't that high before. So when people say, well, how are we going to pay off the debt? Well, we'll do what we have historically done. We'll essentially grow our way out of paying off the debt, but the chances of any significant amount of the principal of this debt being paid off ever is extremely unlikely based on history. And we could go through dozens of countries and find the situation is similar over the last 200 years. So things to remember are that the markets are challenged, but there are opportunities, although I would argue the S&P 500 would not be one of them. I think you can make a safe case that a higher allocation to private assets makes sense. Taxes are already going to be higher in 2020, and we may not have seen the last of the increases yet to come, so we should be prepared for that in terms of designing portfolio and compensation. And on the issue of debt, I'm not trying to be sanguine, but I am saying we have been here before on debt, and so this is probably the one thing I worry the least about when it comes to how all of this will turn out. So with that, I've gone a little over my time. For my apologies for that. But this is the formal end of the presentation, and Nathan or Ethan, I can pass this back to you, and maybe we can take a look at what questions might have arisen.
Thank you for that, John. So we're now going to begin answering the questions. And as a reminder, you can still submit questions. We will be going until 11:30 a.m. Pacific time this morning. So if you can't continue to participate, there will be a recording made available afterwards. The first question, John, is asking you to forecast. Do you expect the next 15% move in the S&P 500 to be up or down? And how about the next 25% movement?
Yeah, that's an interesting question. The first thing I want to say is we are not in the business of predicting markets at all, and we don't believe in investing on the basis that we can be correct about whether interest rates will rise or fall, whether equities will rise or fall by any potential amount. We tend to take a much longer horizon than that. But I will say that we do invest on probabilities. And so if an asset is expensive, you can measure whether it's expensive or not. As I mentioned in the presentation, the S&P 500 in particular is expensive, or was expensive at the end of last year, and it's even more expensive now. So if we were looking at probabilities, the probability would be far higher that the market would take a 15% correction or even a 25% correction down than up, given the level that it's already at currently. So while I'm not predicting that, I would say the odds would favor certainly more of a drop than an increase based on where we are today.
Very good. The next question is, what do you expect the impact of COVID-19 will be on the future of work, such as working from home, and how might this impact commercial real estate investing?
Okay, so I think that's a great question, and it's certainly arisen. We've had many discussions internally about that in terms of how would it change the way we might want to invest in real estate, or would we want to change the mix of the real estate we own and things like that. And so and also as a company, I mean, we have over 220 employees, and how are they going to work? So I think the first thing that's obvious is that if technology allows people to work from home and be more or as productive from home as they would be in an office environment, then logic would have it that you would in fact encourage that and that would continue. So that was continuing as a trend pre-COVID anyway. And when you mix that up with issues like commute time and challenges in terms of work-life balance, it's logical that you would expect to see an increase in remote work. Now, at the same time, um, in theory, that could put a downward pressure on commercial space, unless the other factors include that the space that you have now needs to have fewer people in it in order to, let's say, have appropriate social distancing. So far, everything we see seems to indicate that there isn't going to be maybe quite a significant impact on commercial as space as some people might argue, but there will be some impact. On balance, we are more comfortable and have been for some time. We have a much larger allocation to industrial space and residential space than commercial, and I think that trend for us is likely to continue.
Thanks for that. The next question is, if we have the option, should we consider taking higher than normal income in 2020 in anticipation of higher taxes in future years?
Yeah, that's a really interesting question, and it's very situational. So I'd love to say, okay, yeah, well, clearly you should do that, but it's not a given. So if your income needs, let's say you're retired and your income needs were $150,000 a year, and you can effectively income split with your spouse, any new higher taxes probably will have zero impact on you because they're not going to be at that level. They're going to be at a level that's $200,000 or $300,000 a year of taxable income and higher per person. So again, first you must tend to look at your situation, your facts. But it is true that if you could, if you take a look at salary today, salary would appear to be a more efficient form of taxation, dollar for dollar, than dividends. And on top of that, earning a salary, at least as long as you're under age 71, allows you to make an RSP contribution, which dividends don't. Capital gains are taxed at lower rates than dividends, and that would make a difference as well. So I would say that everybody needs to have their current situation reviewed to see if there's a change that's needed, but it's not automatic that you would accelerate income this year just to avoid having to bring it out next year, because you aren't necessarily going to pay a higher tax next year, and unless you're definitely at a very high level of personal income.
Very good, thank you. The next question is relating to the recent economic developments and in particular the dramatic change in the value of global oil. Do you see this as a long-term trend, and does this affect our strategy?
I always find it interesting because the short answer to that is yes, I do see it as a long-term trend. And I think I remember, I think it was Sheikh Yamani, who used to be the oil minister in Saudi Arabia and was, the head of OPEC, saying that the Stone Age did not end as a result of us running out of stones, and the oil age will not end because we run out of oil. So at the end of it, the oil age will end, and there'll be a lot of oil stuck in the ground, just as there'll be a lot of coal stuck in the ground, and maybe even natural gas. So the reason I believe that in renewable resources for energy is not simply an issue of climate change, as I mentioned, but the fact is that by far 80%, at least 80% of the world's countries import fossil fuels. And it's in the billions and billions, maybe hundreds of billions of dollars of cost to them. If they could generate all of their energy internally on a renewable basis tomorrow, they would. So the drive to create and replace fossil fuels is just going to be driven by some combination of technology and capital, and we will actually get there. So I look at all of these things as quite relatively negative for oil in particular, and I would suggest that the focus needs to be it's not negative for energy, but it is, I believe, negative for fossil fuels, and I think that trend is just going to continue.
I'm just going to keep rapid firing here, John. So
sure.
Are we at risk of a prolonged deflationary environment?
That's another great question because, of course, with all of this debt, the normal assumption is, well, the debt gets monetized by banks, and and that's going to be inflationary. And look what's happened in the past in Brazil and Argentina and in the Weimar Republic in Germany in the 20s and all of these examples. But there's another thing that says that if you just because you actually create money, which is what obviously countries have done now, doesn't mean you can make people spend it. Now, in this case, the governments of the world have basically prevented you from spending it by making you lock down. And so the savings rates in most countries in the world has gone up by a staggering amount. And my view is that even when you can quote return to normal, I don't think spending is necessarily going to return to normal. I think people will have a fear, financial fears about where they are, their own security. Savings rates will likely rise. This is typically what happens after a major crisis or recession. And so that all does suggest, if you reduce spending and you consider the impact of aging and demographics, those tend to be deflationary. So yes, there is potentially a risk. I think governments will do whatever they feel they can. They do not want to see us get into a deflationary environment. But I think arguably there is more risk that might happen than a serious issue with inflation.
You're going to like the next question, John. Do you expect death taxes to come our way? And as a follow-up to that question, should we start perhaps gifting assets that we're intending to gift at the end of life sooner in contemplation?
Okay, again, a great, almost a philosophical question in a lot of ways, but let's look at the issue of death taxes. So first up, I think Canadians have to appreciate that we already have death taxes. So essentially, let's imagine that you have, you had a business or a professional corporation for many years and you're retired. So now you may have a holding company, you've got registered assets, RSPs or IPPs. So the bottom line is that when you die, never mind any specific death taxes, because we used to have them back in the pre-72, 73 period in terms of succession duties in BC. But now, if we take a look at the environment, we would say all of your registered assets in BC tomorrow, and depending on whether probate applies or not, you were looking at a tax of 55%, probably on the entire amount. And then you're talking about a tax of 27% of the shares of any holding company you held, and then any gain on, let's say, recreational property. So trust me, there are death taxes that exist in Canada. There's a fair bit of planning you can do to mitigate that death tax, especially in terms of intergenerational transfer of assets between yourself and your children and grandchildren. And when it comes to gifting, and the gifting can be either within the family or in particular philanthropically. So one of the recommendations we often make is to say to clients, look, the one thing you can't do is you can't transfer your registered assets pretty well to anybody within your family without dealing with this 55% tax. And if you already know that, you've got $1 million in your RIF, maybe you should be thinking, okay, why don't I make the beneficiary of that, let's say my favorite charity, or put it into our family foundation or something along those lines, a donor advised fund? Because if you do that, then the entire amount will go in tax-free, and the entire $1 million, as opposed to $450,000 after tax, will be available to do some really worthwhile work. So I think that there's a huge amount of planning that individuals can do to mitigate the existing death taxes. I'm not expecting those taxes to be added to. Simply increasing the tax rates has already increased them by, well, we just saw in the example we went through, by at least 22.5% in the last 7 years alone in BC. So it's not like there isn't an intent to try to get more money from people that have wealth. That's ongoing.
Thanks very much, John. The next question is, what do you view as the outlook for the Canadian banks?
Interesting. Canadian banks are survivors. I mean, they came through 2007, 8, and 9 in a beautifully. I mean, especially compared to global banks, they were all stars. My sense is that's not likely to change. They're incredibly diversified. They basically have an oligopoly, so that's kind of a protection. They certainly would have the backing of the Bank of Canada no matter what happened. So And the diversification they have really is quite impressive. You know, I mean, they're very big in wealth management. They're not, in my opinion, overly exposed, especially with uninsured loans in the mortgage market. So I look at it and think, okay, yes, they're going to, you know, take some hits. They're going to have some bad loans. They already, in March of this year, I think the Royal Bank was down probably from its peak, I'm going to say 32, 35%. So, but interestingly, while it didn't increase its dividend, it didn't reduce its dividend either. And it did the same in 2007, 8, and 9. So if I remember correctly, back then, the Royal Bank was $60 and it managed to drop to $30 while its dividend remained unchanged. At one point, the dividend on the Royal Bank was over 7.5%. So my view is essentially that when Canadian banks, and for that matter, life insurance companies, take a major hit financially, unless there's actually an underlying business issue, it's a great opportunity to rebalance those positions in those institutions. I think they're on pretty solid ground.
The next question relates to a specific sector, and it's essentially highlighting the performance of the technology sector, especially over the last 5 months and also last year as well. How does that play into the Nicola Wealth strategies for the equity funds?
It's an interesting question. I mean, obviously, we do have exposure to technology, and there's no reason to think that things like online retailing or not, the Amazon effect, if you will, is not going to continue. Although I would make the observation that the increase in the value of Amazon this year far, far outweighs the increase in the earnings that they're going to experience as a result of additional new business. But the reality is that online retailing, any version of online gambling will increase over time. And cloud computing is a large part of this. So I would say that technology, again, will it grow faster than the overall economy? I think that's probably a safe bet. So these are areas that one would otherwise want to take higher weights in, provided that you're not paying a multiple that is already discounting the future earnings of those areas over a multiple number of years. So that's a balance issue to some degree, but generally speaking, I would be a fan of especially the larger technology companies. I would make an observation, though, that it's not going to surprise me to see some of the companies, less probably companies like Microsoft and Apple, get regulated compared to, let's say, Facebook and Google. And will that have an impact on them in terms of their growth and their outcomes? And I think there might be some issues that those type of companies have to deal with in the future.
The next question is, who holds Canada's debt?
There is, most of the debt would be held. We don't really have a lot of foreign owned debt in Canada. So most of the debt is owned by individuals. Any combination of individual investors, institutional investors, life insurance companies in particular, have a large part of the debt. Huge amount being held in a variety of pension funds in Canada. I think people forget that as much as and I'm trying to remember what the global amount of the federal debt, I'm just dealing with federal, not provincial, but it's something like, I'm going to say $700 or $800 billion. And now obviously maybe it would be going up over $1 trillion. Yeah, but the investable assets of Canadians is probably some multiple of that, $7 or $8 trillion now. So I would say that 80%, I don't have the exact number, we could certainly check that out, of the debt is held by some form of Canadians as individuals or as institutions. And then recently, a certain amount of the debt has been monetized by the Bank of Canada as well.
We're getting a couple questions about the Canadian dollar, so we're turning you back into a forecaster here a little bit, John. So what is your outlook on the Canadian dollar, and how does that impact the performance of investments with Nicola Wealth?
Okay, so that's difficult. We try not to choose investments on the basis of the country they're in. But let's just be realistic. I mean, Canada is something approaching 3% of global wealth. So that means then there are 30 times the opportunities to invest in real estate, in debt, in equities, private or public, that are not in Canada as opposed to that are in Canada. I think the last time I looked, we had a roughly 40 to 45% of our assets were held outside of Canada. And whether they were global equities or global bonds or real estate, private equity, private debt, all of them have exposure to various aspects of the non-Canadian marketplace. So the first thing is that we will go and make investments on the basis of where we think value exists, notwithstanding any currency issues. And we tend not to hedge back into Canadian dollars because over time, we assume that the cycles will take care of themselves. I don't have a particular opinion about where the Canadian dollar will go. I would say that certainly from when we went through this at the beginning of this year, you know, the Canadian dollar had actually got quite weak. I mean, it went from, I think at the end of the year, around $1.31 or $2 US to $1.42, and so and then it's now turned back again. So in terms of predictability, I would say trying to decide on whether you need to hedge on Canadian dollars versus American dollars is it only applies if it makes a difference to the way your business is run. From an investment perspective, I don't think it makes a difference. You make a decision on investments about where you feel that you can find them and what in your mind represents good value.
The next question is an interesting one. What are your feelings on the future of nuclear power as a complement to traditional renewables?
Well, nuclear power is supposed to be a no-go zone in terms of, you know, people that want to do want to support renewable energy. I mean, in my mind, nuclear power seems to make a huge amount of sense because basically, notwithstanding incidents and accidents that have occurred, it seems to me that generally speaking, compared to the impact of fossil fuels, for example, nuclear power is relatively benign. And the fact is, we understand how the technology works. Presumably, we could improve on the safety issues related to it. So I would tend to support nuclear energy, especially as a replacement for carbon-generated energy outcomes. But I think at the end of the day, on a political basis, that's going to be a tough sell.
The next question is relating to the public market and the sentiment that in the future things will get better. You know, yet still 40 million people are still unemployed. And the comment is that we know that private companies, just as many public companies. What is your opinion on the outlook for small and medium enterprise?
So it's interesting during this period of time. I mean, I've been a member both of two different business peer groups, and other senior leadership members in our company have as well. David Sung, our president, is a member of YPO. So we have had the opportunity to converse on a regular basis, pretty well every week, with business owners across the country and have a pretty decent sense of exactly how many of these people are performing. And I will say that there's no question some of them have been almost completely shut down, but many of them have gone through and adapted extraordinarily well. So I'm a big fan of resilience. My belief is that what we're looking at in the business marketplace is we are going to see a very good recovery. There are going to be certain businesses that will never reopen, and there will be, but my mind tells me that ultimately they'll be replaced by businesses that don't exist today. I think people forget, I think the statistic that I last looked at, this is just for Canada, is we have something like 1 million small and medium-sized enterprises in the country today, give or take. And we generate 115,000 new businesses every year, and 100,000 businesses fail every year. So we add 15,000 net. It is the nature of the beast. It is a cycle that occurs within the private business marketplace. So this will accelerate some of that change, but I don't think it'll change the trend.
The next question, comments earlier about the private asset. In light of this and relative to the past, will the Nicola core model increase the degree of private assets, specifically private equity and private debt?
So I think the short answer to that question is yes, we see that increasing on a gradual basis. I mean, it always comes down to opportunity. Sometimes we're in situations, we have at least two of our funds that are in private assets. One of them value add in terms of the real estate development pools that we do, and the second in terms of private debt, where we have a wait list. That is, we have clients waiting to get into the fund, and we aren't accepting any new money because we are not able to productively have that money placed in the assets we'd like to place them in. So while we would see a gradual extension of private assets as part of the percentage, this is really what's occurred over the last 20 years already. So we think that trend will continue with us. It will be gradual because we're not going to just automatically dump capital into private areas without being able to find the same diligence that we would use when we're buying public assets as well. So you might see a difference of 1 or 2% per year, but it wouldn't likely be much more than that over the next 4 or 5 years.
We have time for one more question, John.
Okay, sure.
Our public REIT distributions or our private real estate pools, can you talk a little bit about the taxation of each, and are the returns on those taxed differently?
No, actually, they're taxed the same. I mean, a real estate investment trust essentially is a trust, and we operate through essentially a limited partnership, but also with one of our pools as a mutual fund trust. So in that respect, it's treated essentially as if the individual, or in this case, it could be a holding company, owned the asset directly. So if you owned a building, let's say you owned let's keep the numbers simple. You've got a $10 million building, and let's imagine it's got $500,000 of revenue. But by the time you take depreciation on the building, which you're allowed to take, and you take interest expense on the building, the $500,000 of revenue or rental income, only $200,000 of it is taxable in that year. The other $300,000 has been either sheltered or deferred as a result of these other expenses. So you've still got $500,000 of rental income, but you've only got $200,000 that you have to declare as income. And if you took a look at the history of the REITs that exist in the marketplace, you can see that only a certain percentage of their distributions would be taxed as rental income, and the rest of it would be dealt with as a return of capital. And the same is true for our real estate pools as well. In that regard, they're quite similar.
Thank you, John. And thank you everyone for attending today's webinar, Wealth Planning in the Context of COVID-19. When you leave today's webinar, you will receive a survey on the presentation, and we would appreciate if you could complete it and provide your feedback. You will also receive a follow-up email with a link to a view of today's recorded webinar. If you found this webinar insightful, please join our next session, COVID-19 Rapid Test Development with Dr. Dawn Sin on June 24th at 11 a.m. Watch out for the notification and pre-registration in your inbox, with official registration opening next week. On behalf of Nicola Wealth, thank you for joining us today, and enjoy the rest of your day.
Thanks.